Assalamu alaikum. Have a good day. We are in postgraduate diploma in tax management. We are discussing Module 3, Part 2. Module 3 is analysis of capital structure, cost of capital, working capital, management for taxation. Now we are discussing Part 2. Cost of debt. What is cost of debt? Cost of debt is the overall average rate of organization pays on all of the obligations. This typically consists of a bond and bank loan. Cost of debt usually appear as an annual percentage. The cost of debt is the rate of company pays to the debt, such as bond and loan. The key difference between the cost of debt and the after-tax cost of debt is the fact that interest expenses is tax deductible, and cost of debt is one of the part of the company's capital structure, with the other being of cost of equity. Just for example, if a company is tax rated 35% and before tax cost of debt is 6%. So look here, the effective rate would be 3.9%. How it's possible? So here we have to adjust with the tax rate, because these debt expenses of debt, that means interest of debt, is tax allowable expense. DCT of NBR will allow this expense, and that's why we show all of the expense within the profit and loss account. So effective rate less than the actual rate. So here, after the cost of debt, look here, before tax cost of debt multiply 1 minus tax rate. So before tax cost of debt 6%, multiply 1 minus 1 means 100%, minus 35%, then we'll get 3.9%. And now beta. So we know beta is the volatility of risks of a particular stock relevant to the volatility of the entire stock market. Beta is an indicator of how risks a particular stock is, and it is the use for evaluate is expected rate of return. Beta is one of the fundamental that is stock analysis consists with choosing a stock for their portfolios along with price to earnings ratio, shareholders equity, debt to equity ratio, and several other factors is the statistical calculation. So if we see here how beta express, if beta less than 1, it means that the stock is less volatile than the market as a whole. And a beta, if greater than 1, the stock is more volatile than the market as a whole. And if beta the less than 0, the stock is losing money while the market is whole is gaining. So this way, beta will help us for understanding the investment decision, for taking the investment decision also. A beta is less than 1 means that the stock is less volatile than the market as a whole. While a beta greater than 1 means that a stock is more volatile than the market as a whole. The beta value can be less than 0 also, meaning that either the stock is losing money while the market as a whole is gaining, or that the stock is gaining while the market as a whole is losing money. So this way we can calculate beta, the statistical calculation. So we know also the CPFA formula, finding the cost of equity, we are using capital asset pricing model. So if you see here, this is the formula, risk-free rate of return plus beta multiplied by market risk minus risk-free rate of return. So if, for example, the risk-free rate of return is 6%, the overall stock market has an expected return 12%, beta is 1.2. So what would be the cost of equity? So here, if we fill all of the figure here, then we'll get 13.2%. So what is doing here? Risk-free rate of return 6%. Plus 1.2 is beta, multiplied by 12% is market risk, minus 6% is risk-free rate of return. Sometimes this Market risk minus risk-free rate of return is also called the risk premium also. Now, capital gearing. So, capital gearing is the degree to which the company acquire asset or to which the fund is ongoing operation with the long or short-term debt, and capital gearing will differ between the companies to company, industry to industry, and will often change over a lot of time. Capital gearing is a British term, and US is saying that financial leverage. Companies with high level of capital gearing will have a large amount of debt relative to other equity value. So if we see here capital gearing ratio, we can calculate this way: a common stockholder equity divided by fixed interest bearing fund, or we can calculate capital gearing ratio this way: common stockholder equities to fixed interest bearing fund. This also we can calculate the gearing this way: debt divided by equity multiplied by 100, or debt divided by debt plus equity multiplied by 100. Here is an example. So here, company A and company B. Equity share capital for company A 5 lakh and company B 15 lakh. Debenture of company A 15 lakh and same company B is 5 lakh. So total capitalization is 20 lakh for the company A as well as company B 20 lakh. But structure is different here. So capital gearing for company A is 25%. But company B is 75%. So it means that 75% is using equity. Are here, and company A only 25% using equity. A company is said to be high gear when it has a proportionately higher or large issue of debenture and preference share for raising the long-term resource, with a low gear is done for a proportionately large issue of equity share. If we see a problem here, if it has $5,000 of debt at 10% interest and earnings $5,000 also a year before interest is paid, there are 2,250 issues here, and the weighted average cost of capital is 20%. So what we have to do, we have to calculate the market value of equity, cost of equity, market value per share, and if we support the level of leverage gearing, issue 5,000 more debt and 10% interest, repurchase 562 share as market value per share $8.89. So leaving 1,688 share in issue, then what would be change of ABC? That's just to calculate. So look here first, market value of share, earnings 5,000, weighted average cost of capital 20%. So market value of the company is 5,000 divided by 20%, then we'll get 25%. This is the market value of the company. And if we less the market value of debt is 5,000, then we will get a market value of equity. Just simply we calculate it. The market value of equity is $20,000. Now, cost of equity. What would be the cost of equity? So, cost of equity therefore 5,000 is earning minus 500 is interest. For what? This 10% interest on 5,000 debt. So 500. So this 500, if we minus from that earnings, then we'll get 4,500. And if we divide by 20,000 is the market value of equity and multiply if we 100, then we'll get 22.5%. So this 22.5% is the cost of equity. Now market value per share. So what would be the market value per share? Earnings only 4,500 after paying the interest of debt. The number of share as mentioned in the question, 2,250. So if we divide that and multiply 1 divided by 22.5%, then the market value per share 8.89. The weighted average cost of capital according to the net operating income approach remain unchanged 20% as per the question. So the market value of the company should be still there for 25,000. Earnings 5,000, weighted average cost of capital, and market value is that 25,000. And now market value of debt 10,000. How it's come? 5,000 before, new issue 5,000 debt, so 10,000. So market value of equity is 15,000. Now remaining income would be only 4,000. How? Because 5,000 earnings, if we deduct from that 1,000 interest, because 10,000 debt multiplied by 10%, then we will get 1,000. If we minus 1,000 from 5,000, they will get 4,000 with earnings. So now cost of equity then would be 4,000 divided by 15,000. 15,000 is market value of equity. So we'll get 66.667%, and the market value of the share is still as same as before. So what would be the calculation? Then we can say the level of gearing is a measure of indifference to an investor, because it does not affect the market value of the company nor an individual share. This is because as the level of gearing raises, so does the cost of equity is such a way as per keep both we weighted average cost of capital and the market value of the shares constant. Although in our problem, the dividend per share raised from 2 to 2.237. The increase of the cost of equity is such that the market value per share remain at $8.89. So we solve this problem. And now working capital. So what is working capital? Working capital is a measure of both a company's efficiency and its short-term financial health. So working capital, we calculate current asset minus current liability, and we know the component of working capital measure components inventories, and inventories have the material inventories, work in progress inventories, and finished goods inventories. Also we have the component debtors, cash, and creditors. So working capital, also known as the net working capital, is the difference between the company's current asset such as cash, current accounts receivable, and inventories of raw material and finished goods, or working capital, and its current liabilities such as accounts payable. Working capital is equal to the value of raw material, work in progress, finished goods, inventories, and accounts receivable, cash also, less accounts payable. If we see a cash generation disposal process, we know there is some operating activities, some cash inflow and outflow that is a regular basis for operating side, and some are irregular basis. So regular basis, this cash generated here, and also irregular cash flow. Irregular cash inflow is sale of bond, sale of stock, sale of preference share. This is a one time or two times, etc. So it's irregular that comes here, and from this purchase, sale, everything, all operating activities get generating here, and irregular cash outflow is yearly we are paying the dividend, also interest payment to the debt securities, and sometimes if tax purpose quarterly advance tax we are paying, and yearly after assessment all total tax paid. This is the irregular thing, not regular item. So this is the irregular cash outflow, and sometimes this cash, from that cash we purchase the fixed assets, we purchase the material, labor, and fixed asset. When we sell, that cash again generates, and from the fixed asset taking the depreciation, labor, material, and then produce and take the finished goods in inventory, and when it sell is the cash generating again, and when the finished goods item we sold in credit, that receivable increase, and from that receivable if we collect, that amount goes again to the cash. So this is the cash generation and disposition processes describing here. And cash management is the process that involves collecting and managing cash flow from the operating investing and financing activities of a company. In businesses, is a key aspect of an organization's financial stability. Cash management is important for both companies and individuals, as also it is the key component of financial stability. And financial instruments involved in the cash management contain money market fund, treasury bill, and a certificate of deposit. Companies and individuals offers wide range of service available across the financial marketplace to help with all types of cash management, and banks are typically a primary financial service provider. So look here, if we see here how revenue grow. If we can keep our customer, we can retain our customer, and our item price able to make high, and selling price make high, then our revenue growth increase. Then we can assure our revenue growth. And if we attract our new customer, and we can take a new market, we can launch the new product also. This revenue can be growth. And operating margin, we can grow better deals with supplier for cheaper item, taking the cheaper item but good item, and also the automation if we do it, and return management. That means always we take the time management motion study if we apply, and we introduce the automation within the factory, within the company, then we'll able to manage the operating margin also, and automated payroll, overhead, everything can be saved here scientifically. And capital efficiency, we can increase higher return of asset, and proportionally use the technology also, and inventory, increase the inventory turnovers, and inventory, taking the inventory managements, taking the buying supply chain efficiency also. This way we can manage our cash. We will be able to manage our cash flow, growth, revenue, operating margin can be increased, capacity of the company can be increased, also capital efficiency can be increased. So if you see a cash management technique that helps business growth, how? Always have to monitor it. Monitor cash flow regularly, bill prompt and accurately, and enforce the fast payment, designated cash flow monitoring, use available technology, just that can be continue monitor. If we were able to do it, then we'll be able to manage our cash within the organization, personally as well as organization. Look, here is a question: working capital management. Here is an example of working capital management. A company is a gross profit is 25%, not considering the depreciation is the cost of goods sold. And next year is the following figure is saying here. So look here, sell 1,200 lakh, and also within the country, within the home, 1 month credit is allowed. And export side, 3 month credit allowed, sale is 540 lakh. Material use 450 lakh. A supplier extended 2 month credit. So wages paid half month area, that is after 15 days, and 360 lakh is the expenses. Manufacturing expenses paid 1 month area, 540. Administrative expense also paid in 1 month area, 120 lakhs. Sale promotion expenses payable quarterly, here 60 lakh. Income tax payable fourth installment, 150 lakh. But it's not for that financial year, it would be next financial year. So we will not consider in our working capital this amount also. So the company gave 1 month stock for each raw material and finished goods. So is the current asset. 1 month stock of raw material have to keep it, and also for the 1 month finished goods have to keep, and believes to keep 20 lakh as cash. So 20 lakh taka have to keep the cash. Also 15% safety margin taken. So what we have to do, we have to assign the we have to estimate the working capital requirement of the company for the next year. So how much money need for working capital? So if we go for solution here, at first we know the working capital we can calculate current asset minus current liability. So first we have to calculate the current asset. So current asset, the component of current asset is here: cash, raw material, finished goods, debtors in domestic, debtors in export market, sale promotion expense, etc. is the current asset item. And current liability item, raw material for the creditors, wages, manufacturing expense, administrative expense, etc. is the current liability. So first we will calculate the current asset. So cash 20 lakh have to keep. So it's the specific 20 lakh. Then raw material have to keep for 1 month. So if we 450 lakh divided by 12 months, then we'll get 37.50 lakh for 1 month raw material have to keep is the current asset. And finished goods. How finished goods we calculate? First, look here. We have to calculate an cost of production. Material use 450, wages paid 360, manufacturing 540, administrative expense 120. Total cost of production is 1,470 lakhs. So this 1,470 lakh for the 1 year divided by 12 months, then we'll get for 1 month finished goods 122.50 lakhs. And now debtors for domestic market. Here 1,200 for domestic market sale. So 1,200 divided by 12, then we'll get 100 for debtors for domestic market sale. And now for export market, 540 divided by 4 multiplied by 1, then we'll get 135 for export market. And sale promotion expenses 60 lakh is the quarter, 1 quarter 15 lakh. So total current asset is 430 lakhs. Now we have to calculate the current liability. So current liability, raw material for 1 month, raw material yearly needs 450 lakhs. If we divide by 12 months, multiply by 2, for 2 months we'll get the benefit for raw material, because after taking the raw material we will pay 2 months later. So 75 lakh. And wages for 15 days, that means 15 lakh. Manufacturing expenses also for 1 month. Administrative expenses paying after 1 month. So here 120 divided by 12, we'll get 10 lakh. So total liability is that 145 lakh. And from current asset 430, if we minus current liability 145, then we will get 285. And from 285, if we multiply safety margin 15%, then we'll get 42.75. So 42.75, and if we add 285, then we'll get working capital requirement 327.75 lakhs. So this is the working capital management. Also a working capital calculation is here. Now, marketable securities is the very liquidity security that can be converted into cash quickly at a reasonable price. And marketable securities are debts that are to be sold or redeemed within a year. These are financial instruments that can be easily converted into cash, such as government bond, common stock, certificate of deposit, etc. An example of market security include commercial paper, banks accepted treasury bill, government as well as in our Bangladesh Bank treasury bill, other money market instrument, etc. So a market security, there are different types of market security. We have market security, treasury bill, commercial paper, negotiable instruments, banks acceptance, etc. And capital market security, we know the equity capital, that means common share, bond, etc. And sometimes there are some derivatives, but in our country we have no that types of item. Marketability means that the ability to sell a significant volume of securities in a short period of time, and the secondary market without significant price concession. And determination of inventory of an accounts receivable, if we see here, and also current liability. We know in accounting equation is the total asset equal to total liability and owner's equity. So if we see here, liability, it means different types of liability. Some are fixed liability, some are current liability. So if we see the current liabilities are some the creditors, bill payable, outstanding expense, bank overdraft, a short-term loan, provision for our other debtors, others payable, tax payable, etc. as the current liabilities. So the current liabilities are a company's debt or obligation that are due within 1 year. Management need to know the source of short-term loans so that the short-term financing is needed, and we will understand the availability of the cost. Look here is an example. We have to calculate the operating cycle. A food company produce 100 restaurant in deals. The company's collection period is 32 days and keep its inventory 10 days. So what is that company's operating cycle? So if you see here, operating cycle would be that 32 days collection period and add the inventory 10 days, then we'll get 42 days. So 42 days is operating cycle. Same way, also we can calculate here operating cycle 81 days, takes 47 days collection on the receivable, and the company's cost of goods sold 3,12,455. So what is the level of inventory? Level of inventory is here. Look here. So here cycle 81 days, days sell outstanding 47 days, cost of goods sold inventory comes here 29,105. Company's 31 days for average pay to its supplier. It's also know that the days sales of inventory 54 days, outstanding 34 days. What is the cash conversion cycle? So if we do this cash conversion cycle, then we'll get 57 days. And same way, another company net sale 4,23,000 with 30% of being credit sale. Its cost of goods sold is 3,24,000. The company's cost cash conversion cycle is 47.9 days. The company's operating cycle 86.3 days. So what we have to do, we have to calculate the accounts payable. What would be the accounts payable? So accounts payable is calculating here. Look here, net sale this one 4,23,000. Credit sale is 30%, that means 1,26,900. Cash conversion cycle as given in the question 47.9 days. Operating cycle 86.3 days, and cost of goods sold 3,24,000. So just putting data in here, we'll get the firms as the accounts payable is 34,087. It's all for today. So our next class of this module, that is part 3, we'll take the income tax with the deferred tax calculation and other tax calculation also. Let's sum up what we discussed today. We discussed cost of debt, beta, and we discussed the capital gearing, and we discussed solve the problem, and we discussed the working capital, and we discussed the cash generation, cash management, cash flow, and also we solve the working capital management problems here, and we discuss marketable securities, marketability, and we discuss the current liabilities, and we solve just one question is here. So it's all for today. Inshallah, we'll meet you again. Allah Hafiz.